Welcome back to the IB Investor channel. I would like to begin this video by saying thank you for your support. The start of this channel has begun much better than I expected, and it's only thanks to you guys. And I would certainly say that it has fueled my energy to press on. Now, in this video, we'll take a look into the massive luxury house of LVMH, or Moët Hennessy Louis Vuitton. Just a small warning, I'm probably going to kill it when it comes to the pronunciations of many of these French names because it's just so difficult to pronounce them. But anyways, the company was founded in 1987 in France, Paris. However, some of the brands that they own are much older. For example, Christian Dior was founded in 1946. Dom Perignon or something like this, I can't pronounce it, has its roots from like the 1800th century. So yeah, they have some brands within this umbrella or corporation that is just, super old. The company is currently owned and operated by the Hinault family, but it's really Bernard Hinault who runs the place, and the family owns roughly 48% of the capital, much of which I think it's roughly 41% through the investment vehicle Christian Dior, which also happens to be listed on the French stock exchange. And altogether, they hold roughly 63.5% of the votes of the company. And just as a side note, I think the founder, Bernard Hinault, or actually he wasn't the founder of this company, but Bernard Hinault was recently one of the richest guys in the world, if not the richest one. The company is a big one. It is a 341 billion market cap company. It offers a 1.84% dividend yield. The stock has performed a 17.2% CAGR for the past 10 years. The debt to EBITDA sits at 1.28 times. Now this picture paints a pretty good overview on which companies that they own. So the LVMH house, if you will, is home to 75 distinguished houses rooted in 6 different business areas, as I've listed them here on the right side. So it's wines and spirits, fashion and leather goods, perfumes and cosmetics, watches and jewelry, selective retailing. We can also see here that they have some other stuff going on. So private equity through L. Carterton, I can't pronounce the name, but yeah, something like that. And they recently, as you can see on the right side, the Birkenstock company was listed recently on the stock exchange in the US. But yeah, it's just a mess. They have a lot of companies here, and some are very known. For example, the Christian Dior brand here on the right side. I think everybody knows them. Louis Vuitton, also one of those super famous companies or luxury brands out there. And then there are some other, brands that I've never heard of because I'm not personally a fashion guy. So I never heard of Chowling, for example, or Krug. But there are many, many companies here. But especially in the other activities business unit, they have like newspapers and hotels and so on. So it is somewhat of a investment company, you could say. So it's not just the fashion stuff or leather goods or perfumes. They actually have real assets as well, such as real estate, and I think they even build luxury yachts. So it's really a diverse company when you look at it from this point of view. So there is so much more under the hood compared to what the name gives away, so to speak. The company is very associated with these handbags. So on the left side here, you can see some of the example handbags. I'm not sure if these are the most famous ones or not, but those are the ones I found on the internet. But these handbags are quite expensive. I saw some listings. I'm not sure if they're ever going to sell for those prices, but there were some listings for like 29,000 US dollars, which is just crazy. But I think the less expensive ones for these type of bags, if it's like a normal handbag, I think they go for somewhere around maybe $1,800 or maybe $2,000 or so. But there are probably some distinguished, non-disclosed auctions happening, in behind closed doors that probably can far exceed these prices that I just mentioned. But on the next slide, we'll see what kind of cash cow this actually is. Now to the financials. It is always a little bit messy when you look at numbers like this, but the company only also reports earnings every 6 months, so that also means that it becomes even less understandable. So for example, for the first and third quarter of each year, they just report the revenues. But for the second quarter and fourth quarter, they also report the earnings. So for this reason, it is a little bit difficult. So that's why we're looking now at the second quarter just to get an understanding on what kind of margins that they have. So yeah, but on the left here we can see the fashion and leather goods, and it's the biggest revenue segment out of the 6 business areas. It is also very profitable at a 40.4% operating margin, followed then by the selective retailing, which is the second highest revenue area with 8.8% operating margin or profit margin. The third one, watches and jewelry, comes in at third place with 20% operating margin. Perfumes and cosmetic, fourth with a 11% operating profit margin. I actually would have thought that it would have been higher here, but 11% is it is what it is. Wines and spirits, the fifth at 33% operating profit margin, which is actually higher than I thought. I would have figured it was lower. And lastly, they have some other activities here and eliminations, but this is where, for example, the hotels and stuff like this comes into play. Now for the profit section here, the group's gross margin came to a 29 billion euros, which is up 16% compared to the first half last year, so year-over-year figures here. As a percentage of the revenue, the gross margins were 69%, remaining stable with respect to the first half of 2022. The operating profit came in at more than 27%, and yeah, I mean, I can say all that I can say are that these figures are just crazy. I mean, these are in par with many of the software companies that I look at. So it is just crazy. And we can also see here that the cost of goods sales here sits at a low 30.5%, which is, I mean, it's like the upside world or upside down world. Like many of the industry companies, their gross margins are almost the same as the cost of goods sold or sales in this company. So it's just it's a crazy company when you look at it, and they are actually producing physical products. So yeah, management has done a really good job here to drive the gross margins up to this level where they are at now. Okay, so here I just want to do some explanation here. This is actually from the Fundsmith annual letter, but just to give an explanation on why it is important to have high gross margins now in the inflation that we're in now, where costs is spiraling out of control. So on the left side, we have a company with high gross margins, and on the right side here, we have a company with lower gross margins. So for this one, they have revenues coming in, and we see immediately that the cost of goods sales goes away by 34%, and they get to keep 66%. Now, on the right side, we have a company that produces 100% of revenue again, and we see that the cost of goods sales is 55%, so they get to keep a much smaller portion of the money, and we can see here that the gross profit is only 45%. Now, if the inflation is 5% here in this example, so we can see here now that the cost of goods sales have gone down or gone up with 5%, so it sits at 36% now. So we can see here that the gross profit has gone down to 64%. But in the end, the decline in profit only accounted for minus 6%. So, but on the right side, we can see that the cost of goods sales went up by 5% again, up to 58%. And now the company only gets to keep 42% gross profit. So in the end, they lost a lot more money on the bottom line. So the decline here for only a 5% cost inflation that affected this number here, the cost of goods sales. Now the drop in profit went down by 18%. So this is why it's really important to have good margins to start with, because the higher margins you have, the less of an impact on cost of goods sales you'll have, as you can see in this example. It is a little bit tricky to explain, but I hope you understood what I mean. There is actually a pretty good video on YouTube as well explaining this, maybe a little bit better than I did now, but I think it's important to highlight why it's such a good business that LVMH have high gross margins. Now for the dividend yield of this company, for the LVMH company, we can see that the trend has gone up and down as with most companies, but it has gone up a little bit here as of late. We can see here during this period, it is closing a 2% yield right now. It is currently at 1.84, but we can see that the yield has been as low as 1% in 2022. However, if we do look at the pre-pandemic levels, so here in 2019, the yield has exceeded 2% at some short period at least, and even here in 2020 we can see that it has exceeded 2%, but it trades roughly in line, I would say, where it's done for the past few years. It's not super overvalued, as seen here on this slide. But obviously, I don't know if the company is going to go to a 3% yield since the stock has declined as of late, or if it's going to go back to a 1% yield again. It's difficult to say, but at least this is how the figures looks like for a shorter period of time at least. Now to give some flavors on the short-term dividend history. So as we can see on the slide, the dividend has increased actually by quite a lot as of late. So it started here at 6 euros in 2021. They increased it to 10 euros and 2022 to 12 euros. So from this year to this year, it increased by 66%. And from 2021 to 2022, they increased it by 20%. And they also recently here raised the interim dividend by 10% to 5.5 euros. It doesn't show here, but in December for this year, it's going to be 5.5 euros. And they also do have some kind of odd payments here. They pay out their dividends semi-annually, basically once in April, as we can see here, and then once in December. And we can also see where the X dates are and so on. But it is divided into two payout dates. Now for the operating performance or management performance, we can see that the return on equity for the trailing 12 months sits at 29.56%, which is, it's absolutely fantastic, I would say. And we can also see that going back a few years, it's been double digits across the board. So nothing really to say here apart from that management has done a really good job here. We can also see here for the return on invested capital here, it's been double digits, at least for most of the years here when looking back, and for the trailing 12 months, it sits at almost 18%. So it's, again, really good. Unfortunately, I don't have a slide for this, but the return on capital employed, as for the second half of the year for this year, sits at almost 24%, which is really, really good again. So management has done a really good job here allocating their capital to the right places, I would say. Now for this slide, we can see the worldwide sales for this company, and yeah, we can see that Asia, and this is actually for the most recent quarter, so for Q3 in this case. So we can see that Asia is actually the biggest market right now with a 32% market share, followed by the United States that sits at 24%. There has been a lot of worry in the market regarding United States in the quarter because, yeah, the investors are worried about the sales here, that it's declining, and we can see here it's declining year over year compared to 2022, so 2 percentage points down. What is also quite impressive, though, looking at this, is that France is actually quite a big player in all of this. So France accounts for 8% of the total sales. I'm not sure if it's because tourists like to go to the legacy stores in Paris or something like this, but even compared to Europe, where it's like 16%, then yeah, France is a large player in this market. But yeah. On this slide, we can see the insider purchasing done by mostly Bernard Arnault, actually. And he's been buying up shares repeatedly over the past year. So here we can see 2023. So most of these are done by himself through mostly Christian Dior, which is the holding company where Bernard Arnault holds roughly like 27% of the capital. So he's a majority shareholder by far. But he also purchases stocks through his Russian doll, which is called Agash. It's basically a family-owned unlisted company where he purchases shares as well. So for the most recent, or after the most recent quarter here, he has purchased roughly 55 million worth of shares here, or 55 million euros worth of shares through the holding company Christian Dior. And he has also purchased 7.7 million euros worth of shares through his Russian doll, Agash. So a combined purchase of just shy of 62.5 million euros just here in October. So quite big purchases from him. But then again, he's a billionaire, so I'm not sure if these 62.5 millions even make a dent for him. But it's always good to see that insiders are buying. Now for some risks ahead with this company, and I think the share price has gone down a little bit as well, or quite a lot actually from the top. But slowing sales obviously is one of the biggest worries, I would say, in the market right now. We've seen that there's been some slow growth in the United States where the sales went down by 2 percentage points, and I think that is what scares the market right now, because there's a lot of buying power normally in the United States. There's also been some margin pressure, there could be some margin pressure in the future. I mean, the company currently has a gross margin of like 69%, which is super high. So I'm not sure if that number is sustainable or not. They're telling us in the report, at least, that they want to defend those numbers at all cost. But it's one thing to say it. It's a different story to execute on that comment. They also have a very nice operating profit margin at like 27% or north of it, actually. And again, I'm not sure if it's sustainable. So that is one of the risks here, that I would say that the margins could be under pressure going forwards because of inflation and cost increases all over the place. There's also the risk of brand dilution and copies. The bigger you get, then, I mean, if it's not exclusive anymore to wear something from LVMH or Christian Dior, then perhaps the customers rather go to Hermes or to some other luxury company like Kering or Gucci in this case. So there's always the risk of brand dilution, where they maybe produce too much of a certain quantity of some product. So, and there's also the risk of copies here, that some factories in Asia produces a lot of copies and sell them, on the open market, and label them as LVMH brands. So there's also a big risk that the brand will get diluted, because a lot of people might see a lot of LVMH stuff, but they may not be the actual true products produced by LVMH, but rather some unserious players out there. And then the last risk that I see that I want to highlight here is Bernard Arnault, who is quite old, and he's here on the picture. He's currently 74 years old, and I'm not sure how much longer he's going to be able to run this company. I mean, obviously, we have Warren Buffett, who's more than 90 years old, so there is the chance that this guy could run for quite a long period going forwards, but it is a risk because this guy is the mastermind of this company. He's the one who's made sure that the company is where it is today on the map. So without this guy, obviously, the company is a different company. Now for the upside of the company, I would say that the multiples are much better today than what they were just a few months ago. And the sole reason for this is that the shares have traded down almost 25% from its all-time high. So obviously that means that the shares are much cheaper today than they were just a few months ago. But we also have to remember that it's quite tough to remember this actually, but since the company does not report any earnings for the Q3, I mean, the numbers don't move much from quarter to quarter, but rather we have to wait for the EPS for the half years. So that also means that even though they sold a lot of stuff now in the Q3, we don't actually get to see the figures on the bottom line until the next quarter. So that I would say it's an upside that the stock is certainly cheaper today in terms of share price compared to a few months ago. The upside as well is that they have pretty good gross margins, as we saw on the previous slides here, and that means that they are a little bit more inflation protected because of even if the goods or cost of goods sales go up by 5 or 6% or something like this, they will be able to defend the bottom line much easier compared to a company with lower margins. So having this very high margins as a start right now for the inflation period is really good. We also see that insiders, or rather Bernard Arnault, is buying the stock, and it's always a good sign when the insiders are buying, because they're only buying for one reason, to get a return of the shares. But in this case, we know that Bernard Arnault is good for several million or billion euros. So these purchases that he's made, I'm not sure if it's just for show or not, but at least he's buying and not selling. The company is owner operated by Bernard, and yeah, it looks like he has a lot of financial strength. And with this company trading at a quite low net to or debt to EBITDA, then I mean the risk is quite low, I would say, in this company. So it also offers the company to make some aggressive acquisitions here going forward. The stock has also performed quite well with a 17.2% CAGR for the past 10 years, and if anything, this company will probably tug along quite well going forwards as well, especially since it has really good and strong management. And if there's any company that has quality brands, it is LVMH. It's just what it is. So the company's really good quality. As long as management can keep up with what they're doing, it looks pretty good. Obviously, it is cyclical like any other business, so the stock could fall from here, obviously, but since it has fallen by almost 25%, it gives the investors a little bit more margin of safety compared to a few months ago, at least. Alright guys, this is it for this video. Please follow and like the video if you liked the video, and subscribe for more content. I'm also going to link a very good podcast for this company in the section below. It's from the podcast Acquired. It is almost 3 hours long, and they go into a very deep dive in terms of the company's history, the previous acquisitions, and a lot of old feuds between previous owners of this company, but also competitors. So it's a very interesting podcast. Anyways, thank you very much for listening, and see you in the next one. Bye bye.